Yeah, go live, I think.
Hey, hi everyone. Welcome to our webinar today, and thank you for joining us on a Friday evening. So, I have with me Mr. Alok Jain. Alok Jain is the founder of Weekend Investing Small Case and has over 28 years of experience in Indian stock market. And Alok, I've seen the small cases that you have been running. You have a fantastic return and performance in the past 1 year. So, welcome to our webinar today. You can give a disclaimer and then we can start on our topic today, which is how to secure your equity wealth with the power of gold.
Thank you, Aditya. Thank you for having me on this webinar, and I'm very happy that so many of you are joining in. We'll talk about securing our financial journeys using gold, and the disclaimer is right there. Let me just share my screen with you. Sorry, uh, 1 second. Okay, Aditya, can you confirm if you can see the screen?
Yeah. Your screen is visible.
Okay, so once again, welcome to this webinar, and the disclaimer of investment in securities are subject to market risk, so you need to read all documents carefully before investing, and registration is granted by SEBI. No way guarantees performance of the intermediary or provide an assurance of returns to investors, and securities quoted are for illustration, not for recommendatory. So let's get started. The topic for the day is shielding equity wealth will go with gold. So the more disclaimer here would be that I have been extremely pro gold for the last 7-8 years, since I started on Twitter and have been offering these small cases since 2018. I think the financial services and financial markets advisory services have done a great disservice to the investors by not reflecting on this very important asset allocation that is, in my view, needed for every portfolio. And because there are vested interests to push equity versus anything else, whether it is real estate, whether it is gold, I think the whole theme has been to just maybe allocate to gold at 2%, 5% kind, or 10%, which is very, very inadequate in my view. So we will see some examples. I'll walk you through some events in history, and what I would like to emphasize here is that whatever has happened in the past, let's say past 3 years, past 5 years, past 10 years, may not be what may get replicated in the next 10 years or next 20 years. So this playbook that people have assumed that Nifty will give us 12% return, and it does not matter whatever happens, equity markets will always go up. Uh, this kind of a sort of a uh, uh, repeated performance of the markets in Indian market, and it is very good that it has happened this way last 3-4 decades. It will probably continue for some more time also, but we cannot take things for granted. You cannot wish away events that will disturb this trajectory. And the prudent way of building portfolios is to look out for uh, you know the events that may shake up this proven path. So this is why, for instance, we take insurance. Why do we buy an insurance for our car? Why do we buy insurance for our health? Why do we buy insurance for our house? Because so far we have not seen any health problem, fortunately. So far we have not met with a car accident. So far our house has not been burgled or has caught fire. But yet we take insurance to protect for that black swan event. If a black swan event can happen to you as a person or to your assets as a house or a car, it can definitely happen to your portfolio also. So the prudent method is to be invested in equities for sure. I'm not saying don't invest in equities, definitely invest in equities, but be aware that a black swan event uh, is possible. You know, we can say that okay, in the last 5 years, last 10 years, last 20 years, had we remained invested, we are better off. So you know what, so what if 2008 happened, so what if COVID happened? But this is all hindsight, and rear view mirror driving is certainly not the best way to do that. So essentially what we need to see is the evidence of how asset allocation, especially with gold, has performed for various economies over various time periods. And does it sort of say something to you when you look at that data? And that's what we are going to do today. So we are all extremely convinced that equities are safe and equities are rewarding, and in the long term everything is hunky dory, and you know we make a lot of money in equity. That is fine. I mean, it is okay. We are a growing economy for the next many decades. I don't think that story will change. In this journey of last 33 years that is depicted here, there have been extreme bull markets: 91, 92, 2004, 2008, and somewhat 2020, 22, and a mini one here. But nobody remembers the stagnation of markets that happened from 92 till, I would say, about 2003. Given if we sort of miss the technology run that happened for a couple of years here, we the Nifty, for instance, in 1992, and this is adjusted back because Nifty index actually started in 95, but they've adjusted it back to show the equivalent Nifty performance, remained virtually stagnant over a period of more than 11 years, right? The same has happened post 2008 also. So 2008 peak Nifty was 6400, and it was effectively broken only in 2014, 6 years later. So imagine 2024 if it becomes a 2008, because we are talking about worst case scenarios. I'm not saying this will happen, but let's assume, you know, January 2008 repeats itself, and we are in April 2024 and it repeats. And the next high that will come around on Nifty will be 2030. Will something change for you? Will you be invested in the way you are invested in? Will you do something about your portfolio if you knew that maybe this will happen for the next 6 years? That is a possibility, right? I mean, we had a 11-year lull in from 92 to 2003, and we had a 6-year lull from 2008 to 2014. So what gives us the confidence that this cannot happen again? Whether it happens for 3 years or whether it happens for 15 years, we really don't know. But all these different phases will be very different from the ones that we have seen in the last 5-10 years. And to extrapolate what we have seen in the recent past is essentially falling trap to the recency bias. So we need to be cautious. We always need to have insurance, and we always need to be invested. So let's go through some multiple scenarios that can create hurdles in our wealth creation journey. So we are on a wealth creation journey by whatever method of investing we may be choosing. I choose to do it through momentum investing. You may be choosing to do it elsewise also. That is also fine. But let's go through some few case studies and how you shield using gold. So the first sort of situation that I want to see is currency related risk. So all our assets, as a resident Indian, all my assets are denominated in our local currency. So if I am holding Indian stocks, I pretty much have them in INR denomination. If I hold a house in India, that is in INR denomination. If I hold any bonds in India, it is based in INR denomination, right? Now, what is the common theme out of all of these assets is they are all dependent upon the stability and the value of the INR. If the INR destabilizes for XYZ reasons, all of them will go haywire, right? So the dependency of our wealth is essentially a dependency on our underlying local currency. Now, first instance that I want to talk about is that of Asian financial crisis. So in the late 1990s, you had this crisis where it started with Thailand, and it included the Thai baht, the Indonesian rupiah, the Malaysian ringgit, and South Korean won. These were the four major currencies which were massively affected. And massive devaluations happened. There was financial turmoil, and it quickly spread across the region, causing a downturn and recessions in many economies. Now, if we look at how the Malaysian rupee, for example, fell, so you can see that the Thai baht, Indonesian rupiah, and Malaysian ringgit, sorry. So Malaysian ringgit fell 45% in just 5 months. A reasonably stable currency fell, and we've done a inverse of currency to show you the extent of the fall. So 45% fall between July 97 and January 98. And guess what happened in the Malaysian FTSE index? The same also fell by 53%. So anybody who was in Malaysia in local currency only assets saw his portfolio fall by 53%, and the currency is also falling. Now, guess what happened to gold in that same time period? Gold was up by 59% in the same time period. So a proper good allocation to gold, even in local currency, would have protected that portfolio largely. I would say even if you invested 25% allocation towards gold, you would have saved significant part of the equity fall in that. So the whole idea is to reduce the volatility in your portfolio, even though a Malaysian index may have after a few years come back up, but the whole idea is that to not have this uncomfortable zone where indices fall and don't come back. Like China, for instance, 2008 high is still remaining a significant marker. Hong Kong, significant marker still. So you don't know for how long the currencies can go for a toss. Number two was Russian financial currency crisis in August 98, and government defaulted on its debt. So this is another huge sort of kind of risk that exists, where we tend to assume that the sovereign debt is pristine and it can never default, but that is not the case. Everything can have a fall. I mean, we put our money in the banks assuming that this bank can never fail, but banks fail all the time. It is a different matter that in India no bank has failed and the depositors not been replenished. That has been the history so far, right? But there is no law which says that the government has to pay depositors in every banking crisis. So coming back to this example, when the Russian government defaulted on its debt, it devalued the Russian ruble, and the crisis stemmed from some economic mismanagement, declining oil prices, and the Asian financial contagion. Again, you can see ruble fell 65% very rapidly between July and September 1998. Russian index fell almost 59% at the same time period, and gold in rubles surged by 155% in the same time period. So gold is a complementary asset class to any non-USD economy. Gold is a asset which follows the inverse of the dollar index. So the whole idea of gold suppression is that the dollar, when it came off the gold linkage in 1971, when President Nixon said that the dollar will no longer be backed by the gold, Gold went up from $35 to $800 because it had been artificially suppressed down. And the same has been happening the last many decades, because if they allow the gold to float to its real value, then the dollar will look silly in front of that. So every time you will see the dollar index fall, gold will rise. Every time you see the dollar index is boosted up, gold may fall. So gold is a very natural complementary to any non-USD currency. Uh, Third crisis that I want to showcase here is the Turkish lira, the recent 2021 crisis. And the president there, Erdogan, had unconventional views when inflation was rising. He said, "I want to cut interest rates still, and make sure the interest rates are low, even though inflation was going bonkers, 40, 50, 60% kind of inflation was happening." And that just exacerbated the entire situation there. So the Turkish lira fell 57% in a matter of 10 months. And the Turkish index, and I'm using USD terms here to show the efficacy of how this impacted foreign investors in Turkey. So even in USD terms, the index is falling 43%, and gold in the same time period in USD terms is staying stagnant. So again, a portfolio comprising of Turkey's index along with gold would have significantly reduced the volatility of that portfolio. So in many cases that we have seen, what we are seeing is whenever there is turmoil in the local markets, accompanied with turmoil in the local currency, where do you go? I mean, if the local currency is crashing because of XYZ reason, do you think the equity market of such a country can prosper in that time period? So what you will need to counter that situation is something that is not priced in that local currency. So if, let's say, or let me give you more examples about this. Let's take the very famous Japanese example. A lot of people talk about Japanese market, that it is one in a kind market. It will never happen to any other country, so on and so forth. But Japan has been ahead of all other economies in terms of trying yield control, pushing their interest rates to near zero, and so on and so forth. And this may happen to the US at some point of time. So the blue line here is the Nikkei index. As you very well know, that Nikkei index has been in a drawdown since 1990, and only very recently, last month, it has been able to recover all the lost ground after 33, 34 years. But few people see that Nikkei went up 1600% in a matter of 2 decades, starting from 1970. So much liquidity came into Japan for 2 decades that the market went up 1600%. Do you realize what is 1600%? I mean, if Nifty is 20,000, 1600% means 16 times. So Nifty going to, for instance, 3.2 lakhs over the next 2 decades. That is the kind of growth that they saw. And obviously, when you will have this kind of a unbridled bull market that will crash at some point, it will take a very, very long time for it to recover and then go up again. Anyhow, so the decade where the market was going up, you can see this orange line is the gold price in Japanese yen. The first thing that you want to notice here is that over a span of more than 50 years that these two charts are there, gold has performed at 2500% and equity has performed at 1600%. This is the first takeaway you need to see here. The other takeaway that you need to see here is that there was a huge bull market in gold, which happened and culminated in 1980, right? And then gold was in a drawdown and it was coming off, and then it started from year 2000 into the next bull market. The equity curve for the Japanese Nikkei index peaked in 1990 and it started back virtually in 2014. Now imagine if you had both these asset classes with you, there was a very, I mean, you would have performed extremely well at least till 1970 till 1990. And then for this period, 1990 till about 2000, you would have had some down periods. But then from 2000 onwards, you would have been again a fantastic growth chart on your portfolio because gold was rising much faster than equity. So the combination, the complementarity of the two asset classes is such that when one is down, the other picks it up. When equities was going down, gold had started to go up, right? When gold was coming off, equities was going up. So it sort of lends itself to that situation where it saves the portfolio from the equity volatility. Now let's come to some other case study of geopolitical crisis. So, for instance, the left chart is that of USD Pakistani rupee. So Pakistan has been in a sort of a geopolitical crisis for eons, for I don't know, decades together. They've never been able to get their act together, and the currency keeps falling, falling, falling. And this is how the gold in Pakistani rupiah keeps increasing. So it was 13,300 per whatever gram, and now it is 6,40,000 in the last 24 for 25 years. So this is how. And do you think the Pakistani equity is doing some phenomenal job? No. So this is how the arm janta of any country protects themselves. And you will not believe we have 25,000 tons of gold sitting in the hands of Indians, and they have been one of the best investors out there. They have achieved 11.5% CAGR on their gold investments, while it being only being used as an insurance against other INR based assets. So I mean, the beauty of gold here is that while you are invested in other things, this insurance not only provides a hedge against losses there, but it is also making 11.5% on its own. So that is the kind of the beauty of the asset that is there. Now let's see. For instance, Russian-Ukraine war happened. Another geopolitical crisis. What happens to equity market? Equity market goes down 35%. Russian ruble-based gold goes up 45%. So if you actually had a 50-50 split in the portfolio, you would not be impacted at all in a crisis. Another case study could be the market turmoils in Indian markets in the last many decades. Let's see that this case, because this is more relevant and applicable to us. Now, Nifty 50 index from 1994 till 1996 went down by about 30%, 32%. Gold in INR terms went up by about 28% in the same time period. Extremely good complementarity. Another case could be the period of 2000, after the dot-com crisis. Index fell down almost 48%. Nifty is down from 2000 April till about 2003 April, May, down 48%. What did gold do in the same time period? Up by about 20%. So again, extreme complementarity. Then another period of the one that I showed you in the beginning, 2008 to 2013, 6 years of lull in terms of Nifty not being able to beat its previous all-time high. So Nifty remaining in this range all through. Same time period, gold is up 180%. Do you think anybody who had significant exposure to gold in this period, despite equities not doing well, would have lost any money? And then this period is, of course, most of you have lived through this, even if you are very young. COVID crisis, Nifty falling from October October 19 till August 2020. There was a fall in March of 2020. Even if Nifty came back after this crisis, Gold in the meantime went up 48%. You can see that exactly where the fall starts in equity, gold starts to rise in the local currency terms. This is almost like a magical sort of situation that happens. So having exposure to gold, in my view, is not a choice. It's not that you can choose to not be in gold. You have to be in gold. And unfortunately, the narrative that has been built around gold by even investors like Warren Buffett, that gold is just a piece of rock, it does not give you any dividends, it is not a productive asset. But just look how it performs, not only in regular market. In regular market, it is giving you 11.5% CAGR in INR terms, and in crisis terms, it will just try to hedge for all the other local currency losses that you will have. So in my view, it is an absolute must that you must have gold allocation, and not just a 1 2 3 4 5% allocation, a good allocation to gold, because that will give you that peace that you require in your journey. So given that background, what we've done at Weekend Investing is we've created a combination of equity and gold portfolio, where we have a conservative strategy, and we offer it and marry it with the safety of gold, so that it becomes a fantastic equity plus gold instrument. Even if you are not doing asset allocation outside the small case system, for instance, you could invest in the 20 strongest stocks from the CNX 200 universe, which is basis the momentum strategy, underlying momentum strategy. So allocate 75% to equity, and you allocate 25% to gold, and on a monthly basis you rebalance these weights, so that the gold component is always there at 25% to save you. So this strategy runs on a rotational basis, so every month there is a rebalance, and a few stocks may change. The universe is CNX 200, which is the top 200 stocks in the market, the most well known, most liquid, and you can say almost the best quality stocks that are available at the National Stock Exchange. And you marry those 20 top stocks with a gold ETF, and you rebalance it on a monthly basis, and you essentially try to beat the market benchmarks using this. So to promote this concept, we are having this code Gold Rush. You can avail a discount of 20% on this strategy MI Evergreen, and this is valid for the next couple of days. So just to give you a brief on momentum investing, also in case you are new to momentum investing, momentum investing is a factor investing style where you allow your thesis or your picks to be based on price trends. So imagine that there's a horse race that is happening, and 50 horses are running, and let that analogy be of 50 stocks of Nifty, for instance. Now you want to bet on the winning horses. So you want to bet on the cohort that is winning, the group that is in the front. So after, let's say, 2 laps, there are 10 stocks or 20 stocks which have moved in the front. There are 20 stocks which are in the middle, and let's say the 10 are lagging behind. Who do you bet on? Right? What is the natural reaction to this answer? The natural reaction is that I want to bet on the first 20 horses. I'm sure some of them will come at number one, number two, number three, and so on and so forth, so that the combined pack together gives me a better outcome than if I were to invest in the middle pack or the last pack. Then let's say another couple of rounds happen, and a few horses from the front pack move into the middle, some horses from the middle move into the front, and maybe some horses from the rearmost move in the middle, and this jugglery happens. So after a few rounds, we do a rebalance, and we check out stocks that have not been doing so well in the last few rounds, and we bring new stocks in. That way, you are always having winners in your portfolio. It is like the Darwin thesis of survival of the fittest, where automatically by selection you are allowing the weak stocks to get rid of from your portfolio, and you're allowing new winners to be in the portfolio, and you allow your winners to run as fast or as long as they want to run. But as soon as they start to lag, as soon as you find a laggard, you remove them from your group. So this is very much almost like how nature is working. Your body will throw away dry cells, bring in new ones. Or when some farmer is doing some farming, he will weed out all the weeds and allow the good crop to grow, right? So this is exactly the same concept, where you allow your winners to run, and the momentum strategy will sort of ensure that stocks that have run so well so far will continue to run much farther ahead. So I think I've taken a lot more time, more than I expected, on this presentation. So Aditya, let's open it up for any Q&A if we have some.
Yeah. Alok, we can stop sharing the screen. We
Okay.
can take the questions from the users. So basically, we have five pertinent questions from the users.
Okay.
So right now, the global economy is in doldrums, and there are geopolitical tensions going on, because of which the gold prices have shot up. So what is your view on gold? Like, do you see a rally in gold? Do you see them stagnating once the geopolitical tension tames down?
So my personal view on gold is that the gold has not even started to do what it is supposed to do. So the context of this is that since COVID times, actually since 2008, but even if we see since COVID times, the world has printed, tons of trillions of dollars. The global central bank balance sheet in the US used to be like 3 trillion. Now it is like 8 or 9 trillion. So they've just pumped the entire world with lot of liquidity, and hence all asset classes are rising up, because that liquidity will go find some place to sit, and inflation is sort of not budging from where it is. So the world has been accustomed to low interest rates in the last decade and a half, and for the last 40 years interest rates have been falling. If you take out any interest rate chart of the last 40-50 years, you will see there has been a secular decline in interest rates, and it went to zero. Now that decline has ended and the other direction has started. So we are in a situation where uh, the entire world has a lot of debts. US itself has like $35 trillion of debt, and interest rates are not going down. They are just barely hanging in there and likely to go up also. So when you have so much debt in the system and you have rising interest rates, it is a recipe for disaster. And because with rising interest rates, it is difficult for corporations, it is difficult for people to pay back their loans, it is difficult for new loans to be taken up. So this is a huge crisis, and the US dollar essentially will need to be devalued significantly to alleviate themselves of this problem. And because the gold is an antidote of the US dollar, when the dollar will get devalued, gold is going to go through the roof. So what move we have seen so far is, gold going from $2,000 to 2,300 something. It is like, getting warmed up. It's not even started. So when gold starts to go, you will see, 100, 200, $300 kind of moves in a day. That is where you may say that, yes, gold is getting too hot right now. But right now, the way it has moved, it is just, I would say, pretty much getting ready. And I would avoid sort of trying to trade gold, but make it like a permanent allocation in your portfolio, just like you would want to have equity allocation, sort of for the entire life of your portfolio. You want to have a gold allocation, and I've shown you enough examples to prove to you that any issue that happens with the local currency, And we remain very sanguine because we have not seen turmoil in the last 30 years. But in 1991, in Dr. Manmohan Singh's government, uh, India came to a situation where we had to sell our gold, or at least mortgage our gold. And bad economics, bad governance can always happen. We cannot always rely on the fact that the way the current governance is happening, that can continue for the next 50 years. It may not happen. This election itself, who knows if there is a big surprise, what kind of HD government you will get. So you always have to protect yourself. You cannot sit on the laurels that it has not happened in the past and hence it will not happen in the future. That is just being plain, sort of being very naive. If you've never had an accident in your car, does not mean that you will not stop wearing seat belts, or you will not have a braking system in your car. Anything can happen at any time, and you have to be prepared for it.
So in your MI Evergreen small case, you have a 25% exposure to gold. So
Yeah.
what do you think should be an ideal exposure to growth gold for any investor? Like he might be an aggressive investor or a moderately cautious investor. What
So
is the ideal location
thumb
according to
rule,
you?
my thumb rule is whatever is your net worth, you divide your age by two. So if I am 50, I should have 25% of my net worth in gold. That is my suggestion. A lot of
Got
people
it.
may feel that it is a lot, but I think this is the minimum you should have, because the kind of world we are living in, we are you know, one nuke away from a worldwide disaster. Everybody is sitting with their thumbs on the red button, and while however secure we may feel at any point of time, a crisis is just waiting to happen. So in that situation, my suggestion here is that, let's say your equity portfolio gives you 15% CAGR. Let's just assume that a 15% CAGR is what you're able to get from your portfolio. And now assume that there is a chance of a disaster in your remaining lifetime. And I can bet you, if not in my lifetime, in many lifetimes of the young viewers, there will be many such disasters. If a insurance can be bought for 25% of your allocation, which gives you 11.5%, so you've given up, let's say, 3.5% of returns on that capital. But if that eventuality happens, that 25% covers for most of your losses of the rest 75. Why will you not do that? Right?
Correct.
So it is that kind of a scenario, of a simple insurance scenario. You're saying, I'm willing to pay 1% of my car value as insurance. If something happens, something bad will happens. So you have to plan for that. I mean, it's just prudent way of planning for yourself, for your family, for your children. You just can't go in unprotected way.
So basically, whatever is your age divided by two. So if it is 40 divided by two, so 20% should be the minimum allocation to gold.
That is my thesis. A lot of people will not agree with it, but that's what I believe in.
The major questions that users are having is there are multiple ways to invest in gold. There is gold ETF, sovereign gold bonds, gold mutual funds, physical gold, chips. So how to buy gold? Like what according to you is ideal way to buy gold?
So the hierarchy of the let me first explain why gold is the only asset in this world which does not have a counterparty risk. See, if we have a house, the land record at the municipality proves that it is our house. Otherwise, whoever has the possession owns the house, right? It's only because there is a legal system and the land municipality says, okay, Alok Jain owns this house, hence that is my house. So there is a counterparty, right? I mean, I am assured of my asset because of that counterparty, right? I have a equity portfolio. It sits in a CDSL, Zerodha, or some broker's demat account. He is the counterparty to me. or an NSDL is the counterparty. If NSDL says tomorrow, no, Alok Jain, you don't have any stocks with me, I can do nothing about it, right? It is a counterparty risk. If I put my money in the bank, even as in an FD, the bank owes that money back to me. If it defaults, there's a counterparty risk. Yes, government may help me, but on the face of it, this is the counterparty risk. So the only asset which has no counterparty risk is physical gold. If you hold that gold in your hand, and if you are able to make sure that nobody robs it, I mean, that is with zero counterparty risk. So whenever countries feel that their gold deposits are at risk with some other country, they withdraw it from there. Like Germany has withdrawn all its gold holdings from New York. Many countries have done so. India still has 50% of its gold sitting in Bank of England. If Bank of England says tomorrow, sorry, we don't have that gold anymore, what can India do? Right. So, I mean, I find it extremely risky that our country's gold is sitting there. So the pristine level of uh, gold as an asset class is physical gold. The next best is sovereign gold bonds. And the reason for that is that you are having a counterparty as a sovereign, which is the most pristine of counterparties, right? And more than just the counterparty quality, you are also getting a capital gains. On maturity, there is no capital gains, and you're also getting a 2.5% interest on this bond. So it is like almost 11.5% of post-tax uh, uh, capital appreciation. And even if you tax the 2.5%, you're almost at 13% post-tax returns, which is phenomenal actually for an insurance product. You are insuring you against other things. So from that perspective, sovereign gold bonds is extremely attractive. Then post sovereign gold bonds, one level below that would be the gold ETFs. Reason there being that they are extremely liquid. Sovereign gold bonds not so liquid, but from a retail perspective, it's a myth that you will not be able to liquidate. You will always be able to liquidate a sovereign gold bond, maybe 0.5% lower, maybe 1% lower. That's the hit that you will take at best if you have to, in emergency, liquidate that. There are always buyers for sovereign gold bonds in the secondary market. So the next best is the gold ETF. Some of the ETFs have been there for a long period of time. They are extremely liquid, uh, and quality of the management of the AMCs is extremely good. Uh, but again, the question could be that is the ETF backed by physical gold? And you can go to their office and check the physical record of the custodian. They will be happy to show you that in case you want to do that. So that is the third level. The fourth level is maybe digital gold, where you can buy and sell on digital platforms, and the gold sits with a third party uh, custodian or a vault. And I think the last category would be the gold mutual funds. I'm putting them in the last category because the expense ratio usually on these gold mutual funds is much higher than any of the expenses of the higher categories. So why would you want to give up? And they are not very tax efficient either, the gold mutual funds. So from a returns perspective, SGB probably beats all of them. From a counterparty risk perspective, there's nothing that beats physical gold. And from a liquidity perspective, probably nothing beats gold ETFs.
Thank you so much, Alok, for the explanation that you have given for all the gold categories. I'm very sure all the audience must have really found it useful because it is a big question that how to invest in gold for most users. The next question that I have from user is, if I'm booking my profits in equity stock market, should I park those profits into gold or should I reinvest into equity? Like, what is your take on that?
So we have a free product called NG5050, where we allocate 50% to a Nifty ETF and 50% to gold ETF. And we've been doing this for the past 7, 8 years. And I have found that it is the best parking vehicle to use. Whenever you have any liquidity that you may want to use 6 months, a year later, or something like that, you can always park it in this vehicle. While it is not risk free, and virtually nothing is risk free, uh, it maintains a very unique balance between the equity and gold. And as I showed you on several charts, even if equity goes through some turmoil, you'd have a counterbalance there. And this portfolio has returned, I think, somewhere close to just double-digit returns. So from the last 7, 8 years, it is almost, if you are getting out of some investment and you want to reinvest, but you want to wait and you want to hold your money in some parking, I think this instrument could be used. But of course, if you really want no volatility and no risk, then the only option is to go to the bank and sort of uh, park it there till you find another use.
Got it.
One thing that I want to add here is that people have often seen debt funds as risk free.
Correct.
This, because again, the same reason applies, that the last 30, 40 years, the world has seen the interest rates come down. So interest rates keep coming down, bond prices keep going up. Now that regime is changing, bond prices are collapsing and interest rates are rising. So bonds are, in my view, extremely risky instruments now. Somehow that that name bond and the way it has been marketed gives you that feeling that you are safe. But no,
Correct.
bonds are not safe. If interest rates goes up by 2%, you will get killed in the bond fund.
Correct. Basically, investors need to know how the bond dynamics work before
Exactly.
investing into.
And the dynamics of last 40 years, because of recency bias and because it has happened in the past and hence it will happen in the future, that story, it just continues to be replayed. But things are changing. I mean, yeah, and that is why we are having so much global turmoil, because interest rates are not able to go down now. At the start of 2024, which is just 4 months back, there was expectation that there will be 6 or 7 rate cuts in 2024. We
Correct.
are already down to one, and that too because there is a US presidential election. So for as a sop to all the citizens, there will be one rate cut, which may just be it, and there may not be any more. So things are changing extremely rapidly. Inflation is not going down, and you are seeing what is happening in the US, what is happening in the Middle East, how China and Taiwan are, sort of yeah, yeah, standing their fort. Anything can happen anytime. It may so happen that maybe Trump may come in as the next president, and he may just say that all Chinese imports from tomorrow, 40% import duty on that. There can be huge geopolitical implications of a new regime, and how our currency will react to it, because we are exposed to INR in all our assets mostly. Most people don't have gold. Just imagine how much central bankers are buying gold. I always ask whoever asks me that why should we buy gold, I say, you give me the answer to one question only: why central banks all over the world are accumulating gold? Why don't they accumulate oil? Why are they not accumulating copper? Why are they not accumulating silver, aluminum, any metal, any commodity? But they're all accumulating gold, because
Correct.
gold was the basis on which that entire monetary system was erected. And whenever they will want, they will go and reprice gold. It is like that asset in your balance sheet, which is sitting on old book value, and you can always reprice it to the market, or make sure that the market gets repriced according to that. So the gold has extreme significance, even if US dollar is off the gold standard. And there is something called the Exter's pyramid. The users can go and Google it: EXTER. Exter's pyramid is a thesis where the entire monetary system is built on the tip of whatever gold is there in the central banker's hand. So whether it is currencies, whether it is derivatives, whether it is other forms of financial instruments, all rest on this base of gold. So this is why central bankers are left, right, and center increasing gold allocation in their international reserves. China is trying to reduce its US dollar holdings. India is increasing gold reserves. Poland is increasing. Kazakhstan is increasing. Turkey is increasing. There are dozens of countries who are vying to buy more and more gold. And the reason is very, very simple, that the current system has run its course, and there will be a new system. Maybe not in my lifetime, if I'm not lucky, but maybe in the next, the younger people are watching. Sometime in their lifetime, they will see a huge change in the way the monetary system works, because the current system has run its course.
That was a fantastic explanation, Alok. I have one big question. If a investor is new into the stock market, has 100% allocation to equity, but now wants to take some exposure to gold, so what should be his strategy? He should sell some equity and buy gold, or for the incremental flows he wants to put into equity, he can direct into gold.
I think you can start incrementally, because you want to have full confidence on what you're doing. And as you will allocate incrementally, you will find that, maybe gold will also give you some returns as you gradually come in, so that, your sort of margin of safety will also start to get built in gold. I can tell you one thing, that in the last 50 years, Indian gold has never fallen more than 25 or 28% from any absolute top. So the safety that you get with gold versus equity is at a different level. So gradually come in over 1, 2, 3 years, and build your gold exposure. The best way to do it is, again, physical gold, SGBs, whichever way you like, or if you want to gift your wife some nice jewelry, that is also good. No problem in that. You'll probably uh, save a lot of money in terms of forced saving towards this investment, and also protect your investments and all your other INR assets. So this is very key, which one item that is usually not given any emphasis on is the INR. Can you really say that INR can never get disturbed? Maybe not in this government, maybe not in this regime, but what if 10 years there is some other kind of government that comes in, or some other geopolitical event happens around us? We are surrounded by countries who are bankrupt.
Correct.
There's bankrupt Pakistan, there is bankrupt Sri Lanka, there's bankrupt Nepal, and Bangladesh is no better. So we are, and China is our aggressor anyways. So anything happens at any point of time, right? So you have to protect yourself.
Correct. So some of your investors into MI top 10 small case and MI 25 are asking that should we take exposure to gold as well? Because there is.
Yes. So if you are having uh, uh, strategies which have already built in gold, like evergreen, then of course you don't need to. But if you are in pure equity strategies, you can always add gold exposure as an asset allocation. So I mean, as research analysts, we are not allowed to give any personal sort of recommendation. But if you consult with your financial advisor, I'm sure they will advise you on adding gold to your asset allocation. And in general, as you are maturing, as you go from your 20s to 30s to 40s, always build asset allocation in your portfolio, because equities are really good, but equities can also give you sleepless nights. So you want to have a stable
Correct.
portfolio which protects you from that kind of volatility and heartburn. And in case something happens to you tomorrow, you want to make sure you have a house, you have investments other than equity also.
Correct. Ensure your sleep with gold. Just don't go
Absolutely.
100% into equity.
Absolutely. I mean, I know people who don't invest in equities, don't invest in real estate, only invest in gold, and they've done really well. I mean, essentially, the game is compounding over a long period of time. At 11.5%, if somebody compounded for 50 years, they've made huge wealth. They don't need equity,
Correct.
right?
Based on your answers, Alok, based on ideal way to invest in gold, people are scared whether gold ETFs are safe or not. So can you just give some like
See,
view or thought on that? That are ETFs, gold
so
ETFs safe or not?
when we see, this is actually what users should also think about is when we say gold ETF, whether it is safe or not, that question arises because gold is a safety asset, right? The inherent purpose of buying gold is safety, and hence the instrument gets questioned that whether gold ETF is safe or not. But at the same time, we are holding equity ETF without any doubt, right? Nobody is
Correct,
questioning whether Nifty ETF is safe or not, whether any other sectoral ETF is safe or not. Nobody is asking that. Just because gold is there in this ETF, the question comes whether the AMC is playing right or not. So I think the safety and the transparency and the, I would say, risk that is there in a equity ETF, it is the same in the gold ETF. If
correct,
XYZ AMC is having a Nifty ETF, probably, if they are not having the gold underlying for a gold ETF, they probably don't have the underlying for the Nifty ETF either.
correct. So, Alok, I'd like to know some like closing remarks for you. Like, how should investors move ahead? How to deal with Nifty? Because Nifty is touching that all-time high and then again retrieving back. There's some volatility at the top, and we are seeing some resistance. So, how are you seeing markets ahead? And what are your thoughts for our investors before closing it for the day?
I think one thing is very sure that India has a great runway ahead of us for the next decade or two. That is reasonably sure. I am just hoping that there not be any situations where we mess up and not fly our plane on this runway. And I think the biggest mess ups happen because of investors themselves. They try to time in and time out of the markets. They try to do all kinds of leveraging things when they're not, sort of full time into the markets, or have their ability to deal with leverage. So just make sure that you don't do anything silly in the market. Make sure you remain invested in the market. Most people cannot time the market. At least I can't. So I remain invested in the market. I know market is a two-step forward, one step back kind of situation all the time. So, if you made money in the last 2 years, if you have to give up something as some correction comes in at some point of time, that is okay. That is the nature of the market. You have to absorb that. You can't have the upside and not have the downside. That is just not how markets can be played.
Correct.
So stay with the markets. Make sure you are asset allocated. In case you're leveraged, reduce leverages. We've had a great run in the last whatever 6 months, and actually even more time. So there is one concept of sell on news, which I think can happen when the election results are out for some time period. So that just may precipitate some selling at that point, but just speculation. So if you're in for the long haul, don't even bother about small 6 month, 9 month type of corrections also. I mean, just keep your vision 5 years ahead and make sure you have a strategy that is self correcting, self healing, and make sure that you don't do any major mistakes. That's about it.
Thank you, Alok. Thank you so much for
Thank
your
you.
insightful knowledge because really it takes a lot of knowledge, wisdom, and experience in the stock market to talk on such breadth about a simple asset that is gold. And I am very sure that you know much more about it, but we could wrap it up in this 1 hour session on how to deal and invest in gold. So thank you everyone for listening. Stay tuned and we'll be coming back with such interesting webinars ahead.
Thank you.
Thank you.
Bye bye.
Bye. Thank you.